Facebook recently reported their quarterly earnings for the second quarter of 2018, and Facebook's stock dropped over 20% after the earnings release. Did Wall Street overreact to Facebook's earnings? After going through Facebook's earnings and several Wall Street analyst reviews of Facebook, we couldn't help but wonder, did Wall Street overreact to Facebook's earnings? We reviewed the good and the bad of Facebook and looked to see if the company had a solid catalyst for future growth, something to keep the Facebook boat afloat and moving forward. So what we found was that lost in the noise of the 20% stock price decrease, Facebook's revenue grew 42% year over year, which is a real feat considering. We found growth all throughout Facebook's presentation. Daily active users grew in all four categories when compared to Q2 2017. For categories of Asia Pacific and the rest of the world, Q2 daily active users saw an increase over Q1 2018. We saw the same thing with monthly active users, growth in all four categories when compared to Q2 2017. And in monthly active users, Facebook saw growth in 3 of the 4 regions when compared to Q1 2018. When it came to revenue, as we stated earlier, revenue increased by 42% year over year and increased by 10% from Q1 2018. Average revenue per user grew in all regions in Q2 2018 year over year, and net income increased by 31% year over year and by 2% from Q1 2018. So growth, and more growth is what we gathered from the slides provided by Facebook. Why did the stock take such a hit? Let's talk about the causes for concern. Analysts expected a higher revenue number from Facebook, and Facebook missed this number by $120 million. Analysts also expected a higher monthly average user number than Facebook was able to achieve. Facebook also reported an operating margin that was lower than Q2 2017 and Q1 2018. The company spent a lot more on capital investment than it did in Q2 2017 with reason. Facebook's management gave an outlook for the company's revenue growth dropping by high single digits over the next few quarters. The company also reported it expects to lose users due to new privacy policies. So with slowing revenue growth, slowing active user growth, and shrinking margins, the downgrades followed. UBS and Nomura downgraded Facebook to neutral, Morgan Stanley cut its price target to $140 per share, and Piper Jaffray cut its price target to $200 per share. So as an investor or potential investor in Facebook, there's a lot to process. A lot of headwinds for Facebook, but still, is a 20% decline warranted? Is it really that bad? Though it doesn't seem like it based on Wall Street's reaction to the earnings release, Facebook warned us all of slowing revenue growth and of their shift in focus from advertising and back to the online community that made it great to start. Wall Street and the public were warned, and that warning came on the heels of the company dealing with the Cambridge Analytica issue. Before that, Facebook had to deal with the issue of outside influences using Facebook to persuade US voters during the election, an idea that Facebook once scoffed at but had to backtrack on once the evidence was revealed. Between those issues, it was a busy quarter for Facebook's management having to deal with the press, foreign and local governments, and their users. People were mad at Facebook over the Russian voter influence and the Cambridge Analytica scandals, and they had a right to be. But the delete Facebook chants didn't really play out like many thought they would. I'll admit, Facebook does have some problems, and it has a bit of a building with a buddy band feel to it. It was cool, but now your parents are on it, your grandparents are on it, so you're looking for something new. Snapchat for a time used this to their advantage and saw phenomenal growth amongst teens and young adults. However, Facebook used Instagram to stunt Snapchat's growth. So Facebook may not be as cool as it once was, but the company owns Instagram, and Instagram has been picking up the slack. So what's the future of Facebook? In the need to be first and react, we feel Wall Street overlooked a lot of the good that still surrounds Facebook. Instagram, as we mentioned. In the last 2 earnings calls, we've only heard management address Instagram as growing nicely. A 2017 chart from Statista showed Instagram stories blowing past Snapchat stories. FYI, Snapchat started the story feature first. When Facebook purchased Instagram for $1 billion, many analysts, some of the same analysts telling you how bad Facebook is now, stated the Instagram deal was a bad deal for Facebook. Fast forward 6 years, according to a Bloomberg report, Instagram would be worth $100 billion as a standalone company. For comparison, Snapchat's market cap is $15 billion as of this writing. There's also IGTV. We see this as a catalyst for growth because of creators' frustration with YouTube. YouTube is still the place to upload content and become a star, and that won't change overnight. But the platform is making it harder for smaller creators to make anything off of YouTube. And YouTube has been frustrating established creators with the company's lack of transparency on what is monetized and what is demonetized. You're watching this on YouTube, so you've probably heard a creator or two speak about the apocalypse. If not, Google it. YouTube creators have been searching for another platform. Amazon has provided Twitch, which some creators have taken to, and Facebook has now entered the arena providing creators with IGTV. Then there's Facebook itself. As we stated earlier, Facebook today isn't the Facebook from 2009. It's not necessarily the cool thing, but it's still relevant. It's still a prime place to advertise, and 98% of revenue for Facebook still comes from advertising. In an article by Source Knowledge in 2016, digital advertising surpassed TV advertising, and the article suggested TV ad spends would make up less than a third of advertising budgets by 2021, while digital advertising will account for half of the ad budget. The overall trend favors Google more than it would Facebook, as Google has a larger portion of the digital infrastructure. But a rising tide raises all ships, and the advertising money being spent in digital is rising. Now, we don't want to make light of the Russian interference and the Cambridge Analytica scandal that Facebook dealt with. We definitely want Facebook to be better corporate citizens and protect their users from questionable and dangerous influences on the platform. Facebook now appears to understand their responsibility to its users and has beefed up spending to try to prevent past events from happening again. So we're okay with the company increasing capital spending. While Wall Street has downgraded the company because of their expected spending to make the platform a safer place for users, we believe Facebook still represents the place to advertise and will likely be a better place for advertisers once better mechanisms are put in place to prevent another Cambridge Analytica situation. We don't see Facebook going out of business in the next few years. We feel the company is being good at embracing what the people want. We believe they'll continue to do this in the future. Instagram continues to grow nicely, and it's still the it platform in social media, and IGTV could add another long run of growth for Facebook. The massive sell-off by Wall Street was overdone. Facebook still sells the best product any advertiser could want, and that's your information. And as long as we log in, check a page, respond to a message, wish a friend a happy birthday, and hit that like button, the company will be fine. Thanks for checking out our report on Facebook. May your next investment be your best investment.